A man named Warren Buffett is dying, and he just left a warning that most people will ignore until it hurts. He warned that the value of the dollar can get worn down, while also holding an absurd amount of cash and short-term government bonds. And the worst part is this: people are already misunderstanding what he meant because they want the easy story, not the correct one. This is not financial advice, this is financial education, and you need to hear it in 2026, not after the market drops again. You are living through a decade where jobs are being automated faster than anyone admitted out loud. You are watching housing detach from wages like gravity was turned off. You are being told inflation is coming down while your actual purchasing power still feels like it never came back. And you are seeing stock indexes float to new highs while ordinary households quietly bleed out. So today, I want to show you the real mechanism behind the kind of cash pile Buffett is known for, and why that mechanism has nothing to do with a magical collapse where the dollar turns into worthless paper overnight. It has to do with timing, with how liquidity is managed when the financial system starts to choke, and with how the people at the center of the system quietly reposition while you are still arguing about narratives on social media. And yes, we are going to get specific. You will hear real numbers. You will hear how the Federal Reserve's interest rate choices ripple into your rent, your job security, your retirement, and your chances of surviving the next shock. You will also hear why Buffett's letter does not mean what most people think it means, and why that misunderstanding is expensive. Let's start with the part nobody wants to say out loud. Buffett is not a conspiracy theorist, and he is not romantic about money. He is a professional allocator of risk. When he warns you, he is telling you the stress points he sees in the machine. And when he holds cash, he is not holding cash in the way you are holding cash. In 2026, your life is already shaped by those stress points. If you work in a middle-class job, you have probably watched AI swallow tasks that used to require humans. You have watched companies cut headcount and call it efficiency. You have watched the creator economy sell you the dream of passive income, while the reality is most creators earn $0 and treat views like a paycheck. And if you are lucky enough to still have savings, you have watched real inflation slowly erode them year after year, even when the headline number looks calmer. This is why Buffett's warning lands like a punch. People hear dollar becomes worthless and their brains jump to disaster movies. They imagine a day where everyone rushes to buy gold, crypto, canned food, and watches. But that is not what his behavior suggests. If the dollar were about to be rendered useless in the next few weeks, the smart move would be obvious and immediate. So ask yourself this, seriously. If you believed your cash was about to be destroyed, would you sit on it like a tourist? Would you keep paying rent with dollars that you know are about to become paper? Would you keep holding stocks that you think are about to collapse rather than rotating into something you believe is safer? Here is the uncomfortable truth. People say they want safety, but their actions reveal they want comfort, and Buffett's letter is designed to remove comfort. He is basically forcing you to admit that you do not actually understand what currency risk means in a modern financial system. And here is where it gets truly ugly. The dollar does not need to become worthless for your life to get worse. It only needs to get slightly weaker relative to the cost of housing, relative to food, relative to healthcare, relative to insurance. Small changes compound, and you feel them in your body, not in a spreadsheet. Pattern interrupt. Think about the last time you got a raise. Then think about how much your groceries changed. Think about how your energy bill changed. Think about how your insurance changed. Now think about how many of those increases happened while someone on TV insisted inflation was tamed. That contradiction is not an accident. It is how the system manages perception while you manage survival. Now, about Buffett's cash. People see cash and immediately assume money in a jar. But in professional finance, cash is a category. It can mean plain cash, it can mean short-term treasury instruments, and it can mean something that behaves like cash because it matures quickly and can be sold quickly without locking you into a long-duration decline. This is the part most charts hide from you. The chart you saw online probably showed a spike in Buffett's cash holdings, but the real story is what those holdings are doing for him. He is not betting that the dollar becomes toilet paper tomorrow. He is positioning for a world where the timing of interest rates, credit spreads, and asset prices matters more than your belief in a storyline. Let's build the mental model you need. Short-term treasury bills are like ice. Plain cash is like water. They look similar from far away because you can value both in dollars. But they behave differently. Ice can melt into water quickly and it can be converted, but it still has structure. If you buy a bill that matures in 3 months, you are not locking yourself into a 10 or 20-year interest rate gamble. You are choosing flexibility. When conditions change, you can react fast. So when Buffett holds huge liquidity, it is not just "I am scared." It is "I am prepared." It is a war chest designed for when panic creates mispricing. Now we need to connect this to what the world is actually doing in 2026. The Federal Reserve is not just playing with interest rates in a vacuum. Every time the Fed changes policy, it changes borrowing costs for businesses and households. It changes the discount rate used to value stocks. It changes the attractiveness of treasuries relative to risk assets. It changes credit conditions. And because housing is financed through debt, the housing market is one of the first places you feel it. The rent you pay is not just the market. It is the market plus the cost of capital plus the failure of wages to keep up with price inflation. So when Buffett talks about the dollar being worn down, the real risk is not a Hollywood collapse. The real risk is a long period of reduced purchasing power, messy volatility, and periodic liquidity stress where whoever has dry powder gets to buy assets at better prices while everyone else is forced to sell. And you can see his behavior in history. This is not a one-time thing. Every time there has been a crisis, Buffett's liquidity posture becomes a weapon. He tends to accumulate cash and cash equivalents in anticipation and then deploy it when fear drives prices down. Pattern interrupt. Picture a nurse named David. She is 32, she works nights, and she has a student loan payment that never stops. She did everything right in her 20s. She avoided risky investments. She stayed diversified. She told herself that time would solve the rest. Then, 2022 and 2023 happen. Her costs rise, but her wages do not. She tries to cut back, but her rent does not care. Her employer shrinks benefits and quietly pauses raises. She starts to worry about job stability. Then the next market scare hits. Maybe it is a regional bank crisis. Maybe it is a commercial real estate problem. Maybe it is a labor market shock that becomes a recession rumor. David looks at her retirement account, watches it drop, and she feels powerless. But behind the scenes, the kind of investor Buffett represents is watching the same chart and thinking about the opposite question. Instead of how do I avoid losing, they ask, where can mispricing create opportunity for deployment? The liquidity is the key that allows you to survive until your window opens. Now let's break down what Buffett's chart is really showing when people get excited about the cash pile. It is not just the amount of money. It is the ratio of liquidity to total assets. That ratio rises when he increases liquidity relative to everything else, and it falls when he converts liquidity into investments. So a high cash moment can mean one of two things. Either he is holding because he is waiting, or he is holding because he is selling. If you sell stocks and hold the proceeds as liquidity, your cash ratio rises. If you buy stocks and reduce liquidity, your cash ratio falls. Here is where the story tightens. In the lead up to major market events, his cash ratio often starts to increase. That implies he was selling and preparing. Then, as the market panics and prices fall, his cash ratio tends to drop because he deploys capital to buy undervalued assets. The timing is not accidental, it is strategy. In 2005, for example, his liquidity posture was already high compared to earlier years. Then the financial crisis of 2008 arrived. You could observe the cash ratio hitting lows around the crisis period, which aligns with deployment into assets that were being discounted by fear. It is like he is waiting behind a curtain, and when the crowd starts running, he steps forward and buys what everyone else thinks is poisonous. Then the same pattern returns during the period around 2020. You saw a liquidity posture change. You saw cash ratio movements consistent with selling in the buildup and deploying near the bottom. Not because he had a crystal ball, but because he had a system for anticipating risk and waiting for mispricing. Now, this does not mean every investor should copy Buffett. That is not my point. My point is to understand the mechanism. Liquidity is not just money, it is optionality. It is the ability to act when most people are trapped. And in 2026, trapped people are everywhere. Middle-class households are trapped by debt and rent. Younger workers are trapped by job insecurity. Retirees are trapped by the underfunding of pensions and the reality that Social Security is under severe pressure as populations age. If you think governments are just going to keep raising benefits without pain, you have not read the demographic math. The wealth gap is accelerating too. While everyday people chase stability, the top 1% continues to compound wealth, and part of that compound growth is fueled by access to liquidity, access to capital markets, and the ability to buy during distress. You are not just competing with other people, you are competing with structural advantages. Now the next question is the one that makes people angry. If Buffett warns that the dollar can erode, why does he hold liquidity that is denominated in dollars? Here comes the dark understanding. Because he is not holding one thing in one shape, he is holding a system of short-term claims against the U.S. financial backbone. And importantly, his liquidity can be converted quickly. It is short duration. It is not long duration debt that can suffer dramatic price losses when interest rates shift. This is where many casual observers miss it. They assume dollar risk means convert everything away and hide. But Buffett's approach is more nuanced and more realistic. If you are worried about long-term purchasing power, you do not necessarily need to flee every dollar today. You need to manage the timing, the risk exposure, and the probability of needing cash at the wrong moment. And in practice, Buffett often owns a significant amount of short-term Treasury exposure. Short-term means you are not locked into the valuation swings of long-term bonds. He is effectively holding a liquid reserve that can be deployed when opportunity appears. So when he warns about the dollar getting worn down, he is not necessarily warning you about a sudden extinction event. He may be warning about policy-driven outcomes where real value declines over time, plus periodic market stress where liquidity becomes scarce and asset prices become fragile. Now connect that to what the Federal Reserve is doing right now in 2026. The Fed cannot ignore inflation dynamics, but the Fed also cannot ignore unemployment pressures. Every time they change policy, they cause winners and losers. Higher interest rates increase the cost of servicing government debt. They make it more expensive for borrowers to roll debt. They change the incentive for investors to chase yield. And when investors demand higher returns for holding government obligations, the government either pays more or borrows differently. That is not a moral issue. It is mechanical, and the government still needs buyers for its debt. When there are fewer buyers willing to hold long-duration debt at reasonable yields, the government's financing strategy becomes more dependent on short-term borrowing and policy support. That is how the cash story becomes the policy story. Now here is where the cliffhanger drops. Buffett's letter is allegedly interpreted as if he is trying to panic markets. But what he is really warning is the government about the risks of not adjusting policy in a way that restores confidence among debt investors. When the market is priced for stability, investors lend. When stability looks questionable, investors demand higher compensation. If the compensation becomes too high, borrowing can become unstable. And if borrowing becomes unstable, the financial system has to find a new path to liquidity. That path often ends in one of two places. Either the government increases revenue and cuts spending, or the government reduces the real burden of debt by letting inflation do part of the work. Another path is using the central bank to expand the balance sheet and support market functioning. Now, you might think this is a technical debate for economists. It is not. It hits you through your mortgage rates, your credit cards, your retirement assumptions, and the cost of insurance. Pattern interrupt. If you have ever tried to renew homeowners insurance and received a large premium increase, you already understand insurance markets are failing. That failure is part of the climate-driven stress on the economy. It is not just weather, it is risk pricing, it is capital leaving unprofitable regions, it is migration costs, it is the quiet transfer of risk from companies to households through higher premiums and reduced coverage. So when the government's debt strategy changes, you are not just watching a bond market, you are watching the shadow of that bond market appear in your life as higher cost of living and constrained choice. Now the next piece is the bait and switch that most people do not notice. In theory, markets are supposed to allocate capital efficiently. In practice, capital often allocates toward wherever the system makes it easiest to lend, borrow, and hedge risk. Treasuries have a special role because they are the backbone of financial plumbing. The system needs a safe asset for collateral. It needs a risk-free benchmark. It needs a place for money to park when people panic. So when stock markets fall, investors often move money into treasuries. That is the basic mechanism. When the market is calm and growth seems strong, capital chases equities. When risk rises, capital seeks safety. In other words, stocks and treasuries act like a seesaw. Now Buffett's strategy, at least as it is implied by his liquidity movements, becomes very logical. He wants to hold liquid claims that can gain when risk shifts into bonds. He wants to be positioned to buy equities when panic drives them down. He wants to sell bonds when yields and prices are favorable. Then he wants to redeploy into equities when the market starts recovering. But you do not see that cycle in your personal life because you only experience it one outcome at a time. You experience the drop. Then you experience the recovery. You are not controlling the plumbing. And here is the part nobody wants to talk about in American media. Institutional investors, sovereign-like vehicles, and ultra-connected capital can influence market expectations and can move faster than retail. Retail is always late because retail does not have scale liquidity. You are always reacting, not acting. Now we have to bring in the Japan hand story, because it explains why Buffett is not just sitting on dollar risk. He has used access to international capital markets to reduce dependence on one currency and one market cycle. Japan, over the last decade, has had a very different interest rate environment than the United States. While the United States cycled through rate hikes and then narrative adjustments, Japan maintained extremely low rates for a long time. For sophisticated investors, that creates an opportunity. The basic method is borrowed money, invested elsewhere, and reinvested as the currency moves and as equity prices respond. In the simplest description, you can fund in a low-rate currency, invest in assets that offer better yield or better growth, and then manage currency exposure as conditions change. Now, in 2022 and 2023 and into 2024, when the dollar strengthened and the yen weakened, it benefited strategies that involved borrowing yen at low rates and investing in dollar assets. Then, when Japan eventually began to change policy and raise rates, and when currency flows shifted, yen could recover dramatically. A large move is not hypothetical. When Japan adjusted policy expectations and market pricing changed, the yen did strengthen sharply at times. You have seen moves on the order of 15% in certain periods, depending on the time frame and measurement. That kind of currency swing is not a rounding error for a portfolio using leverage or large capital allocations. So Buffett's exposure to Japanese equities and his receipt of dividends can function as a partial hedge against a purely US dollar and US equity reliance. The Japanese companies can return cash through dividends and buybacks. When those actions happen during downturns in the stock market, it can create a stabilizing force on prices. So while mainstream observers focus on Buffett has cash, a more realistic view is that Buffett is running a multi-country deployment strategy. One side of the strategy can be US liquidity and short-term instruments. The other side can be international exposures designed to harvest yield, dividends, and currency-driven gains. And here is where the darkest understanding hits. This is not luck. It is the result of having the ability to wait. It is the result of controlling liquidity. It is the result of being positioned so that you can profit from the outcomes that destroy retail. While you panic sell because you cannot afford to lock capital, Buffett can hold because he does not need your money. While you try to time the market emotionally, he times it operationally. While you are stuck in the same asset and the same currency exposure because your options are limited, he can shift with speed. Now, let's return to your reality in 2026 because this strategy matters to you whether you can implement it or not. What matters is what the strategy reveals about how the system works. In 2026, the wealth concentration is accelerating. According to many measures, the top 1% owns a larger share of wealth than it did decades ago, and that concentration increases their ability to buy during distress. Meanwhile, middle-class savings are stuck in accounts that are vulnerable to inflation and to the timing of layoffs. AI disruption is cutting into middle-class jobs. The learn to code advice that sounded clever in 2020 is now a joke in practice. AI can write code, debug code, generate designs, draft legal documents, and automate parts of accounting. The result is that some entry-level pathways have become narrower, and the remaining work often requires fewer headcount. So you are dealing with job displacement and downward pressure on wages. Now add the retirement crisis. Many pensions are underfunded. Many people delayed retirement because they had to keep working after markets fell, which means the retirement base expands while the benefits promise cannot be supported without cuts or higher contributions. Social Security faces demographic strain. People are living longer, and the ratio of workers to beneficiaries declines. And then add climate-driven disruptions. Insurance premiums are rising, coverage is shrinking, and some places become economically risky to live in. When you cannot insure a home, you cannot finance it easily. That is not just a weather story. It is a financial story. So when Buffett's letter talks about the dollar getting worn down, it is not a metaphor. It is a warning about the system's long-term trajectory, and it is also a warning about the period of volatility during which your ability to protect yourself is reduced. Pattern interrupt. Consider the creator economy illusion. You see videos promising financial freedom through content, but the reality is most creators earn nothing. Platforms control distribution. Ads fluctuate. Sponsorships depend on audience size that is volatile. If your income is not stable, then you are not building safety, you are building exposure. So if you are one emergency away from bankruptcy, a currency erosion story is not abstract. It is your ability to maintain a baseline standard of living. Now we need to address the most important misunderstanding in the entire internet conversation